Welcome to Fintech's Fair Play, your go-to expert source for the most relevant updates in the world of fintech. Today, we're diving into a major victory for UK banks in their battle against the payment systems regulator over fraud reimbursement rules. In late 2022, the Payment Systems Regulator, or PSR, introduced new rules that would have required banks to reimburse customers who had fallen victim to online scams, with compensation amounts reaching up to £415,000. This set off a fierce lobbying campaign from the financial sector, one of the largest seen in the City of London since the financial crisis. The banks argued that this approach was unfair, given that the majority of scams, 70% according to research by UK Finance, originated on online platforms, particularly those owned by Meta, such as Facebook and WhatsApp. At the core of the bank's argument was the idea that they should not be held financially responsible for fraudulent activities occurring on third-party platforms. Fintech giant Revolut supported this stance, revealing that 60% of scams reported on their platform also originated from Meta-owned properties. The question was clear: why should banks, acting as simple payment intermediaries, bear the financial burden when tech companies were profiting from ads linked to scams? One of the main voices representing the banks in this debate was Ricardo Tordera, head of policy at the Payments Association, whose members include major players like Barclays, Visa, and American Express. He succinctly put the case forward: banks are a tool for transferring money from one person to another. We are not the scammers. This intense lobbying effort culminated in a major win for the banks in October 2024, when the PSR agreed to significantly reduce the compensation cap from £415,000 to £85,000. Under the new rules, set to take effect on October 7th, this amount would be split 50-50 between the bank sending the funds and the bank receiving them. The PSR's reversal on this issue was driven by numerous factors. Banks argued that making them solely responsible for such high reimbursements would not only increase their costs, but also potentially encourage fraudsters to take advantage of the system. There was concern that customers might become less cautious with their online transactions, knowing they could claim substantial reimbursements in the event of fraud. The regulator's final proposal does protect customers in 90% of cases, allowing for up to £85,000 in compensation unless the bank can prove gross negligence on the part of the customer. But this reversal came at a time when banks and financial technology companies were meeting regularly with both the PSR and government officials, arguing that the policy, in its original form, would harm the financial sector without addressing the root of the problem: fraudulent activity enabled by social media platforms. For nearly 2 years, representatives from the banking sector held meetings with the regulator and key government figures, warning them of the potential unintended consequences of this policy. One financial crime prevention expert put it bluntly: if you have a pot of free money, people are going to abuse that. The debate also reached the highest levels of UK politics. In April, then City Minister Bima Folami expressed dissatisfaction with the regulator's plans, distancing the government from the PSR's proposals. By the time the Labour Party won the July 2024 elections, banks found a more sympathetic ear in new political leaders. Labour leader Keir Starmer, now Prime Minister, had already signaled his support for banks, stating that they were doing most of the work in preventing and detecting fraudulent transactions, while tech companies contributed little. Despite the policy change, many questions remain about how these new rules will be enforced in practice. The 50-50 reimbursement model between sending and receiving banks requires a seamless system for communication and transferring funds between financial institutions. However, the platform designed to support this system, developed by Pay UK, is unlikely to be ready by the October 7th deadline. Banks may initially need to process fraud claims manually, leading to what some industry experts are calling a total mess. This delay means that come October, many banks and fintech companies will be manually handling fraud reimbursement requests, potentially creating opportunities for fraudsters to exploit the system. As one senior banking policy executive put it, it's going to be Christmas Day for fraudsters targeting customers. While larger banks like TSB have already voluntarily adopted fraud reimbursement policies, smaller challenger banks and fintech companies have been more vocal in their opposition. For them, the new rules present a disproportionate burden, and their concern is that these measures will harm their growth and competitiveness. However, the PSR believes that by capping reimbursement at £85,000, it is striking a balance between protecting customers and incentivizing banks to strengthen their anti-fraud systems. Fraud continues to be a significant issue in the UK, with £459.7 million lost to scams in the last year alone. Despite this, less than 1% of police resources are devoted to tackling fraud, and many experts argue that the current policing model is ill-equipped to handle the rise of online crime. As the UK financial sector adjusts to these new regulations, it's clear that this debate is far from over. Tech companies, who were a major focus of the bank's lobbying efforts, are still not directly financially responsible for the scams that originate on their platforms. And while the new reimbursement rules provide some level of protection for consumers, many in the industry believe that more needs to be done to address fraud at its source. This is an evolving story with far-reaching implications for banks, fintech companies, and the wider financial system. Stay tuned to Fintech's Fair Play as we continue to bring you expert insights into the most important issues shaping the future of fintech. Thanks for watching, and don't forget to like, subscribe, and hit the notification bell to stay updated on the latest in fintech.